Hi, I'm Murray Zelinski, broker-owner of Realty Corp, and we help individuals invest by the numbers. When we talk numbers, one of the things we want to look at is what is our investment going to provide for us, not only from a cash flow perspective, but also from our net returns at the end of the day. As an example, if we had $40,000 to invest, and let's say I went out and bought a mutual fund or a stock, and at the end of 1 year, it went up by 10%. Now, I know some of you are saying 10% is a little bit of a stretch in the markets, but let's just assume that we got 10% on our stock or mutual fund return. At the end of the 1 year, that means on the $40,000, I made $4,000 for a net return on my investment, ROI, of 10%. Let's say I wanted to invest it into the real estate market. Well, the nice thing with the $40,000 that I have is that the bank will actually become a partner for me and allow me to leverage my $40,000 onto a piece of real estate. So what that means for me specifically is I could go out today, buy a $200,000 piece of real estate, put my $40,000 down, and the bank will give me a mortgage for $160,000. Now let's use the same time frame after 1 year. There are three key components that we can look at that the real estate will provide for us in our return analysis. Appreciation basically means is that from where the property is that I bought it at to the value that it increased in the course of 1 year. Let's say as an example the real estate appreciated by 3%. That means my initial property that I bought 12 months earlier at $200,000 is now worth $206,000. That's an equity value appreciation of $6,000. Now, I'm going to buy that piece of real estate and put a tenant, a well-qualified tenant who's going to look after the property for me for the duration, pay me a monthly rent. A portion of that money is going to the bank to help pay down the mortgage. So at the end of 1 year, the balance owing on that mortgage, we started at $160,000, but through the payments that I've been making back to the bank by way of the rent from the tenant, means I've reduced the amount owing to about $156,600. That means I realize about a $3,400 advantage in the mortgage paydown. Now, the other thing, if I've invested with cash flow in mind, and I invested with a good tenant in place, if I've allocated my numbers correctly, that means I'm going to have the tenant cover the tax component, they're going to cover the mortgage, I'm going to put some money in the bank for future repairs and maintenance, and let's say at the end of the day it leaves me with about $100 that I can put into my pocket for spending. Well, at the end of the 12 months, that gives me an additional $1,200. So if we go back and look at the total return on our money, we'll pick up $6,000 as a result of the appreciation in the property. We'll pick up an extra $3,400 by way of the mortgage paydown, and we'll get an extra $1,200 from the cash flow. When we put all those numbers together, the actual return that we'll see at the end of the day is going to be closer to 26.5%. So the same $40,000 that we had in both investments, we're either going to pay us back 10% or 26.5%. You work hard for your money. The key is to have your money work hard for you with successful investing. Visit realtycorpwealth.com and let's talk about successful investment numbers.